All right, let's talk about Didi. The ride-hailing giant just dropped its latest earnings report, and honestly, it's a fascinating one. It tells two completely different stories at the exact same time. On one hand, you see a headline that looks like a total disaster, but you peel back just one layer, and you find a story of a company that's actually getting stronger. So how can both be true? Let's dig in.
So let's get right to it. This is the number that had everyone talking. A net loss of almost 2.5 billion yuan. I mean, that's a huge, scary-looking number. If you just saw this, you'd think the company is in some serious trouble.
But that massive headline loss forces us to ask a really important question. Is Didi's actual day-to-day business losing money, or is there something else going on here, something behind the scenes? This is where our little financial detective story really gets started.
All right, so first things first, we need to get behind that headline number. Let's peel back the layers of that nearly 2.5 billion yuan loss because, as you're about to see, it is not what it looks like.
And boom, here it is. The entire loss, and then some, is because of this one single thing. A one-time legal charge of 5.3 billion yuan. This was money set aside to settle a big old shareholder lawsuit. So this loss has nothing to do with how many rides they sold this quarter. It's really just Didi cleaning up a problem from its past.
And this is where you can see the two stories side by side. The official accounting profit, what they call GAAP, has to include that legal charge. So it shows that big 2.5 billion yuan loss. But if you adjust for it, if you just pull that one-time item out to see how the actual business did, the story completely flips. Didi's core operations actually made a profit of over 3 billion yuan. Two totally different realities.
Okay, so now that we've kind of swept away that accounting mess, let's look at the real profit story. And it really boils down to one key metric that shows just how much better Didi is getting at making money.
And that metric is called the take rate. It's a really simple but powerful idea. For every dollar a passenger pays for a ride, the take rate is the percentage that Didi actually gets to keep as revenue. Think of it like their commission. The higher the take rate, the more efficient they are, and the more profitable the business becomes.
And you can see this happening in real time. Didi's take rate has climbed from 17.4% a year ago all the way up to 19.0% now. Now, that might not sound like a huge jump, but when you're talking about billions of rides, that extra 1.6% is absolutely massive for the bottom line. And they're doing it smartly, by optimizing things like driver incentives, not just by jacking up prices for everyone.
This growing profitability is so important because it fuels Didi's entire strategy. You know, you really have to think of Didi as two different companies operating under one roof. There's a super profitable cash cow at home, and then there's this high growth engine that's expanding all over the world. So let's break this down. In China, the business grew at a solid 12.2%, and it generated a huge 3.6 billion yuan in profit. That's the cash cow. Now look at the international business. It's the growth engine. It's exploding, growing at nearly 28%. But they're investing a ton of money to grab that market share, so for now, it's losing money. The simple story? The profits from China are funding Didi's aggressive global takeover.
But of course, Didi isn't operating in a bubble. To get the full picture, you've got to see how it stacks up against its biggest global competitors. This is a fierce race.
Now, when you look at this chart comparing revenue growth, you might think Didi is falling behind. I mean, 10.9% looks a lot smaller than Uber and Grab. But this chart is a little deceiving. It's a classic case of what they call the large base effect. Didi's business is so massive in its home market of China that it's just harder to post those gigantic percentage gains.
So what's the real story behind that difference? Well, it's all about diversification. Companies like Uber and Grab have huge businesses outside of just moving people. Uber's food delivery business grew at 25%, pulling its whole average up. Grab's financial services shot up by 41%. Didi, for now, is laser-focused on squeezing more profit out of its core business at home, not just growing revenue at any cost.
In this quote right here, it perfectly sums up the new chapter for Didi. It signals this huge shift in thinking, from a company that was constantly putting out fires and dealing with crises, to one that's now all about performance and rewarding its shareholders.
And listen, this isn't just talk. They are backing it up with serious action. Step 1, they fixed their big regulatory problems in China. Step 2, they just wiped a huge legal risk off the books with that settlement we talked about. And step 3, they launched a massive $3 billion stock buyback. That's a huge signal that management thinks their own stock is a bargain.
So all of this, the improving profits, the global push, the buybacks, it all leads to the big debate that's happening right now. What is Didi actually worth? The market is completely divided.
So you basically got two camps here.
On one side, you have the optimists, the bulls. They see a super profitable cash cow in China that the market isn't valuing correctly, and they think the international growth is this amazing bonus. They'll tell you the worst is over. Then you have the skeptics, the bears. They're still worried about risks in China, and they see that global expansion is just burning through cash. For them, the stock is cheap for a reason, a potential value trap.
And that leaves us with the big final question. Operationally, the company is executing a major turnaround. The core business looks stronger than it has in years. But the ultimate challenge is this. Can they convince a skeptical market to believe in the story and finally close that gap between how the business is actually performing and what the stock market thinks it's worth? That's the billion-dollar question.